Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Strategas co-founder, president, and head of portfolio strategy, Nicholas Bohnsack, to talk all things markets. Nick, how are you doing today?
Very well, my friend. How are you?
Doing really well. Thanks for asking. Very, very busy couple of weeks here, so no shortage of things to talk about. Let's start. We are recording on a Thursday, so a day after a Fed meeting, and they hiked interest rates 25 basis points. The market reacted, I think, more to Powell's presser, but I want to just turn it over to you and see what's your takeaway a day post 25 basis point rate hike.
Yeah, well, I think you hit the nail on the head with the market's reaction, which is to say that the Fed chair didn't probably put up his most award-winning performance yesterday. He seemed a little wishy-washy. The inflection in his voice seemed to change from the prepared comments through the balance of nearly a 60-minute question and answer session with the media. And so I very much agree with your takeaway on that. I think the Fed finds himself in a hard place. We've had a couple of real big macro months, between the bank failures and the persistence of inflation and, what looks to be, in some corners, sort of eroding economic dynamics. And at the very end of it, the Fed sort of really looking at the normalization and then ultimately the tightening of monetary policy and wanting to see that, through to a successful conclusion, which I think they measure as arresting, inflation back to an acceptable level. By the chair's own admission, I think they still have some work to go, but they also acknowledge sort of the infliction of pain on the broader economy. So it was a little bit of a mixed message from the Fed yesterday, and I wouldn't be altogether surprised that we see a continuation of volatility in the marketplace until we get out to some speeches in the next couple of weeks, Powell's next public statement, whenever that is scheduled for, and then really probably a period on that sentence with the next meeting where they actually, could ostensibly pause by definition.
Right. And I think the mixed message piece is important, and especially on the heels of, a re-flare up in the regional banking crisis. They mentioned not a lot of concern on that front, but I'm curious if you share that sentiment or how you interpret Fed Chair Powell's comments around the topic.
Yeah, and I thought that was, I don't like to use this word callously. I mean, I thought that was the most dangerous part of his comments yesterday, lowercase d, which is to say that, they feel as though that is behind them. That is always, that's something that's going to come back, and he'll rue the day he may have said that, particularly when, about an hour after his press conference concluded, we started to see rumblings at Pacific Western, right, Pac West, sort of coming under very acute pressure in the markets and potentially representing, another failure. So what I think the market is trying to weigh is, on the one hand, earnings and interest rates, sort of the building blocks of equity price. You maybe see some weakness in earnings. If you take a longer lens, you may be slightly buoyed by the result set that's come out of the first quarter, so taken as a positive. And then interest rates, same story. Real acute tightening program over the last 12, 14 months, clearly starting to have some impact for corporate operators. Generally, sort of conspires towards a more cautious tone. And then on the other side, you have liquidity and labor. The labor market has almost defied comprehension here and remained, pretty strong. And liquidity has been generally abundant. And even as the Fed has tightened financial conditions, we know what's going on with the Treasury General Account. Effectively, fiscal policy has, pumped a lot of liquidity into the system. We know we had sort of the temporary, at least as defined by policymakers, sort of temporary liquidity injections around Silicon Valley Bank, around First Republic, around Signature, and then maybe with a little bit more to come. So earnings and interest rates on the one side, Ross, buoying markets, liquidity and labor on the other side, and sort of in the middle sits this sort of rolling regional bank crisis. And I do use that word specifically, that I think the market really has to pay a lot of attention to. And then if that wasn't enough, we also have in the backdrop the debt ceiling. And you and I have talked a lot about the debt ceiling, but you can really look at short dated, short dated treasury market, 2 months, 3 months, 4 months, 6 months, and really see some important inflections. I think the market is running a little nervous about the way that the debt ceiling ultimately gets, either raised or resolved.
Right, and I think for good reason. There's obviously a lot of discourse on that to come over the next few months, and maybe pulled forward a little bit after some recent data. So debt ceiling, Fed, regional banking issues. Let's flip the script and end. I want to get your take or your opinion. What's something that you're optimistic about, or feeling a little bullish about, or at least gets you in a good mood about the market at this point in time?
Yeah, well, one of the things that amongst all the mire and muck and macro, one of the things that I think is an opportunity is that you really have a chance to identify some really exciting operating franchises. We talk with investors all the time, and they're constantly talking about building portfolios through being more selective, and that is clearly in evidence right now. So within almost every in industry pocket, you see real winners and you see some real laggards. And so finding those opportunities is something that excites us. If you want to graduate up to the next level and say, well, what's been working pretty well, I think investors have to take some optimism away from the fact that the industrials have behaved so well in here. They were a strong performer at the end of last year. They muddled a little bit in January, but they've been strong really coming out of February and through much of the macro malaise that we've just talked about. And the industrial economy is, as much as the consumer, an important underpinning of optimism. And so I think that is an area that advisors and our clients can focus on for some more opportunities, perhaps, than in some of the other sleeves. But the other thing that I would mention is that by no means do we think that this will, by no means do we think that the market is sort of at the precipice of a very sharp contraction. I think that the building blocks suggest that this is going to be more of a drawn out type of affair, and that makes it a really interesting environment for investors to build portfolios. And so I think as much as there's a proclivity to become more defensive or somewhat more cautious, it also allows really good companies to sort of raise their hand and say, hey, we're outperforming in what is otherwise a challenging environment. I start with the industrials, and then there'll be a few other pockets that reveal themselves here along the way.
I think that's a really great point. And as things get, choppier in the macro environment, you're starting to really see a dispersion, especially in this earnings season, of who's built for this and who maybe is built for only a specific type of environment. I've seen you all use the phrase, the market is not a monolith several times. And I think that really applies. So great insights, Nick. We really appreciate the time as always, especially in kind of this choppy environment. So hopefully we'll get a chance to talk to you again soon, but thank you again.
Yeah, looking forward to it. Thanks, Ross.